This voice is taken from an article with the title, How Does Central Bank Policy Impact Currency Valuations?, which has been published on TraderTalks.net. Central bank policy can have a huge impact on currency valuations, as it is the institution responsible for managing a country's monetary policy. This includes setting interest rates, controlling the money supply, and other activities that can influence the foreign exchange market. Interest rates. Interest rates are one of the most important factors that can influence the value of a currency. When a country's central bank raises its interest rates, it makes it more attractive for foreign investors to invest their money in that country. This increases the demand for the currency, and as a result, its value increases. On the other hand, when a country's central bank lowers its interest rates, it makes it less attractive for foreign investors to invest their money in that country. This decreases the demand for the currency, and as a result, its value decreases. Money supply. The money supply, or how much money is available in the economy, is another factor that can influence the value of a currency. When the central bank raises the money supply, it makes it easier for people to borrow money and spend it, which in turn leads to an increase in economic activity. As economic activity increases, the demand for the currency increases and its value increases. On the other hand, when the central bank decreases the money supply, it makes it harder for people to borrow money and spend it, which in turn leads to a decrease in economic activity. As economic activity decreases, the demand for the currency decreases and its value decreases. Exchange rates. Central banks can also influence exchange rates by intervening in the foreign exchange market. This means that the central bank can buy and sell currencies in order to influence their exchange rates. For example, if a country's central bank decides to buy its own currency, it will increase the demand for that currency and its value will increase. On the other hand, if a country's central bank decides to sell its own currency, it will decrease the demand for that currency and its value will decrease. Inflation. Inflation is another factor that can influence the value of a currency. Inflation is the rate at which the prices of goods and services in an economy are increasing. When the inflation rate is high, it means that prices are increasing quickly and people need more money to purchase the same goods and services. As a result, the demand for the currency increases and its value increases. On the other hand, when the inflation rate is low, it means that prices are increasing slowly and people need less money to purchase the same goods and services. As a result, the demand for the currency decreases and its value decreases. Overall, central bank policy can have a huge impact on currency valuations. By setting interest rates, controlling the money supply, intervening in the foreign exchange market, and targeting inflation, central banks can influence the demand for a currency and as a result, its value.